Continuing our Outlook 2022 coverage is Danielle DiMartino Booth, CEO of Quill Intelligence, and she is an expert on all things Fed and monetary policy. Welcome back to the show, Danielle.
It's great to be here on this momentous time as we look to the new year.
It's the day after Fed Day. We usually speak on Fed Day, but the day after is perfectly fine as well. Interesting market action we saw yesterday. Stocks rallied in the news, and news, of course, being that the Fed is indicating a quickening of their tapering program, and the dot plots indicated that there would be 3 rate hikes next year. Before we get into your outlook and what all that means for the markets, I'd like to play a brief clip for you of Jerome Powell's statement just to set the stage on inflation. Can we take a listen to this?
While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put to upward pressure on inflation.
2 main things here I'd like to ask you about and unpack. He said that price increases were caused predominantly by the pandemic. Of course, price increases have spread to most areas in life, but he was saying that the pandemic was the core cause of price increases. Do you agree with that statement?
I think that the pandemic and then the stimulus measures that followed led to the inflation that we have. It wasn't the pandemic in and of itself in a vacuum. It was overly stimulative fiscal policy mixed with monetary policy that has created this inflation that we have.
Okay. Second, he brought up wage growth. This is a concern among some economists I've spoken to. Wage growth could contribute to inflation even further. What do you think?
I think that is certainly a risk going forward. We still have millions of people who are sidelined and out of the U.S. economy that could potentially alleviate wage inflation pressures. And again, that's going to take us right back to the same discussion about fiscal policy and how aggressive it's going to be in 2022. If it continues to be as aggressive as it is, you're going to continue to see, especially lower income workers, choosing to stay out of the labor force, which pressures companies to either pay up more for their employees, pay higher wages, or automate more quickly.
Automate more quickly. Are you talking about robots? Are you talking about a lot of people? Wouldn't that increase in unemployment if automation takes over?
It certainly would, but there are real world examples. I mean, if you go to the Home Depot, there's exactly one individual, one warm body at the checkout. Otherwise, you're checking yourself out. My favorite example is a White Castle south of Chicago, where they've got Flippy, who makes who flips French fries 23 hours a day. He goes down 1 hour a day for cleaning, but Flippy's agnostic to French fry grease, and he has replaced a human being. And there's a kiosk in the front of that White Castle that has also been replaced by a human being. And you've got other examples. Hotel chains have kind of trained a lot of their guests to go without maid service for a few days. So companies in many ways have adjusted to this. And yes, there is going to be a wave of automation, artificial intelligence. All this is coming, and it's been expedited by the pandemic.
Well, let's hope they don't train Flippy to ask questions. Otherwise, I'd be out of a job too. But going back to the Fed now, Danielle, 3 rate hikes were projected by the dot plots. Now, you and I have spoken about the dot plots before. I know you're not a true believer of the dot plots in the sense that they're not perfect projectors of what's going to happen. So do you think 3 rate hikes are a little bit too aggressive, or are they right on the ball?
Well, I think that the economy and the economic data, especially in the first quarter, as well as what happens with the yield curve, the difference between the short end maturity rates and long end maturity rates, I think that is going to be more of a dictator of whether or not that dot plot is even feasible, whether or not the Fed's even going to be capable of initiating a rate hiking cycle. Again, they're going to be, policy will be dictated by how the economy pans out in the first quarter. And as far as we know right now, the child tax credit that many U.S. households have been getting, 90% of U.S. children, 90% of U.S. households with children have been getting this cash infusion every month, average of $550. And they'll also not be getting income tax refunds that they think they're getting because they've been getting this child tax credit in cash. So there are some big bumps that we encounter right off the bat in the month of January.
Powell has stated before that full employment is one of the prerequisites for liftoff. Are we at full employment yet? 4.2% was the latest unemployment rate. It's been trending down, but are you saying we're on the right track to full employment?
I think the key from Powell's most recent press conference is the fact that he said that he was pleased with how much the unemployment rate had come down, even for African Americans. So that kind of helps him check a box and shift his focus back to the inflation mandate, which I think a lot of market participants would agree has been abandoned by the Fed, by Jay Powell in 2021 in favor of that employment mandate. But I think he spoke enough at this most recent press conference, and he echoed kind of the congressional testimony that he recently gave. Jay Powell sounding a lot like he sounded his first year in office, and that should actually make markets nervous.
I just want to think outside the box for a minute here. You talked about the inflation mandate. Besides raising interest rates, Danielle, what else can the Fed do to combat inflation?
Very difficult situation if you've got a slowing economy. There are very few tools that central bankers have to combat stagflation. And if we see persistence in food inflation, which we're likely to see, supplemental nutrition assistance, the program, those benefits increased 32% in October. So American families who are on this assistance program are getting somewhere around $550 a month. And that's why we've seen food inflation run amok. That's not a situation that you can back out of easily, at least.
Let me ask you this. This is just a fundamental exercise. Suppose the Fed disappears tomorrow. Suppose the government does a complete, laissez-faire approach to economics where they let people do whatever they want. They let private businesses just do whatever they want. There's no intervention whatsoever. Do you think corporate America could fix this inflation problem on its own?
Well, I think that if the government was less intrusive, and if you're talking about a world with much less stimulus, I think that you would have millions of workers who would be compelled to come back into the workforce just to put food on the table, just to provide for their basic necessities. So yes, if you let capitalism go back to being capitalism, instead of having fiscal and monetary authorities as intrusive as they are, artificially repressing the flow of labor into the workforce, then yes, I think that you would be resolving many of the inflationary pressures that we've been seeing. Absolutely.
So you think authorities are making this problem worse, or maybe they're helping? Yeah.
How on earth could they be making things better by improving, by increasing by 32% what we used to call the food stamp program in the month of October? And this is very, very obvious politicking on the part of the Democratic Party headed into a midterm year. And they're literally trying to buy votes. I'm not trying to make a political statement. I'm making an observation. And you can't tell me that increasing benefits by 32% is not filtered straight into beef prices being up 22% year over year, poultry prices being up 13% year over year. This is not a supply chain issue that we're witnessing. It's an outgrowth of very poorly conceived fiscal policy.
I just on that real quick, I saw Jimmy Fallon interview President Biden just for fun on his show, and he asked him, "What are you going to do about your low approval ratings now?" And Biden said, "I'm not looking at them anymore." So just to tie that into what you're saying, he said they were high, now they're low. What are you doing about it? He says, "I'm not looking at it anymore." Stocks were up yesterday on the news that the Fed is hawkish. Why? Is the market agreeing with you that the Fed possibly cannot carry through with expectations?
Yeah, I think that right now the market is laser focused on really what the message of the yield curve is. And I think that that's where most, especially professional investors, are focused. And if the yield curve is saying, it's at 80 basis points, let's just say that it continues to decline, and maybe into March, into the first quarter, if the economy does slow, what happens to Fed policy if they're looking at potentially raising interest rates with an inverted yield curve? And I think that was the celebration in markets initially, was they can talk a tough game, but they're not going to be able to execute. And they're not really going to be able to tighten. And in fact, maybe they're going to have to come back and ease more because of the slowing economy. the flip side of that is, and I think that we're seeing a backlash in today's market trading is, I think a lot of traders have gone back and said, well, wait a minute, why are we celebrating a slowing economy? So there's a little bit of an existential crisis going on between yesterday's trading and today's trading, and it's very obvious that market know what to make of a slowing economy and hawkish Fed.
That is strange. Well, let's get your outlook now. Let's talk about what Danielle thinks. You putting all these pieces together. Do you foresee rates to actually go up in 2022? What is the likelihood of that happening? 0 to 100%.
Well, I mean, look, I think that the new Jay Powell, who is the old Jay Powell, I would not put it past him at all, especially given that there is a consensus on the Federal Open Market Committee to go ahead and lift off. So you could easily do the math: $30 billion a month in January, $30 billion a month in February, $30 billion a month in $15 billion a month in March, and you can do the math to make it to where you can get to a March liftoff, that first rate hike in March.
Well, let's assume, for the sake of argument, that all the projected rate hikes from the dot plots happen. So that's 3 next year, 3 the year after, and the 2 in 2024. So that's 25 basis points times 3, 75 basis points next year, another 75 basis points the year after. That's 1.5% over the course of the next 2 years. Can we afford that? I mean, on $30 trillion of debt, that's $300 billion, $400 billion close to. Am I just doing mental math? A year of increased interest expenses?
I would have to say no. The country, corporate America, even households to a certain extent, the wherewithal to shoulder higher borrowing costs in this country is very low. The sensitivity of the housing market to any increase in mortgage rates is rapidly apparent. And we have a lower threshold than we had prior to the pandemic because so much organic demand by millennials has been saturated. So we're an extraordinarily interest rate sensitive economy on many levels, not just on the sovereign level and talking about how much our interest service costs would go up in the national debt. That's just one piece of the puzzle. You've got a massive $1 trillion junk bond market out there as well that relies on zero interest rate policy in order to continue refinancing effectively bad paper.
Okay. So what's this going to mean for the financial markets, stocks in particular, next year?
I think that the stock market is vulnerable, and valuations are really just one piece of the puzzle. I don't know how well the stock market is going to incorporate the reduction in Fed liquidity. And even though we're not talking about shrinking the balance sheet or anything that dramatic, I think that the closer that we get to liftoff and actually raising rates, the more nervous stock market investors are going to be, because that's exactly what we saw in 2018 was the tighter the Fed got, the more nervous the stock market was. And I mean, fortunately or unfortunately, this is someplace that Jay Powell has been. I think he's scarred from 2018, but he has been sounding extraordinarily like the year that he was in office, and we'll see if he's able to stand that line.
If you were Jay Powell, would you sacrifice asset prices, so stocks, for lower inflation?
Well, that's a good question. And I think he's coming under tremendous amounts of fire, particularly because inflation is harming the lowest income earners, the middle income earners who don't have access to all of these stimulus types of safety net types of spending from the government. I think he's at the point where he needs to make a decision. And the question is a very delicate one, because if the stock market was to meaningfully correct, would that not bleed into the real economy?
Yes.
So these are the outgrowths of Jay Powell waiting way too long to become tougher. And I think part of what has been driving this is that there's been a leadership vacuum at the top of the Federal Reserve. I put that on the Biden administration for waiting too long to renominate Powell, because I think that we would have been maybe in a better position, and we might have already started tapering the process of tapering had it not been such a long delay between finding out who was going to be the next chair of the Fed come 2022.
Okay. And finally, how do you feel about gold given your macro and monetary policy outlook?
Well, look, I think that gold has been in a holding pattern for way too long, and I'm extremely bold with my own gold holdings. And I in times of distress, in times of inflation, also in times of deflation, as long as there's destructiveness in the market or uncertainty or this crazy volatility that we've been seeing, gold should become more attractive.
Excellent. Danielle, appreciate your insights. And I want to thank you again for all your help with Kitco this year. Happy holidays, Merry Christmas. We'll see you again next year.
Happy holidays. We'll see you in 2022. Take care.
Absolutely. Thank you for watching Kitco News. I'm David Lin. Stay tuned.